Usually a map gives you, a comforting sense of scale.
Right, yeah.
You look at a city map, you see the streets. You look at a world map, you see the continents. The boundaries are they're clear.
They make sense.
Exactly. But then you pick up a corporate earnings report, and specifically the freshly released July 2026 earnings presentation for BlackRock, or, well, BlackLock, as they are referred to in our source text.
Yeah, and suddenly those boundaries just completely vanish.
It is wild. By like 15 seconds in, you realize this isn't a map of the world. It feels like the map actually owns the world.
You are basically staring at the financial architecture of the global economy, just distilled into a single document.
So welcome to our deep dive into the financial engine of the world. Our mission for you listening today is to decode this incredibly dense 2026 investor script.
Because it's not just a bunch of charts, right?
No, not at all. It is a treasure map showing exactly where the world's smartest institutional money is moving right now. And, how massive macroeconomic forces are reshaping global wealth.
It's fascinating.
Okay, let's unpack this. Because reading corporate earnings scripts can usually cure insomnia.
Oh, absolutely.
But this one features some genuinely wild numbers and accounting gymnastics that we really need to figure out together.
Yeah, we have to dig into it.
So before we track where the money is going, we have to look at the sheer scale of the operation, just to set the baseline.
The numbers are staggering.
They really are. As of June 30, 2026, their assets under management hit $15.3 trillion.
Trillion with a T.
Trillion, just a massive number.
Just to put that into perspective for you, the combined gross domestic product of Japan, Germany, and the United Kingdom combined barely edges out what this single entity manages.
It is just mind-boggling. And from that mountain of capital, their base fees and securities lending pull in $5.7 billion.
Which is a very healthy revenue stream, to say the least.
Right. And the breakdown of what they hold is incredibly revealing about how they generate those fees. So equity dominates the portfolio at 58%.
Makes sense.
Yeah. Fixed income sits at 22%.
Mm-hmm.
Then you have multi-asset strategies at 9%. And then alternatives are at 3%. And digital assets are sitting at 1%.
Right. The smaller slices of the pie.
Exactly. And looking at who actually owns all this wealth, institutional clients make up exactly half, 50%. ETFs hold 41%. And retail accounts for just 9%.
Which tells you a lot about who they are really building products for.
Definitely. But the regional breakdown is what really caught my eye here, because the Americas are overwhelmingly dominant at 68% of the total pie.
That is a huge concentration.
Huge. Meanwhile, EMEA, so Europe, the Middle East, and Africa, sits at 26%. And Asia-Pacific is just 6%.
Just 6%. Wow.
Right. So with 50% tied up in massive institutional capital and 68% concentrated in the Americas, my instinct is to ask, is this truly a globally diversified firm or just an American corporate giant with a few overseas branch offices?
Well, what's fascinating here is that the heavy American weighting isn't actually a lack of global reach.
Oh, really?
No, it is a highly calculated reflection of where global market strength currently resides.
Okay, that makes sense.
Yeah, I mean, institutional money gravitates toward deep liquidity, regulatory stability, and, corporate share buybacks.
All of which the U.S. markets provide in just unprecedented volume right now.
Exactly. But you cannot afford to ignore those smaller allocations we talked about.
The 1% and 3% pieces.
Right, because in a $15.3 trillion portfolio, a 1% allocation to digital assets represents over $150 billion.
Okay, when you put it like that, that is massive.
And a 3% allocation to alternatives is nearly $500 billion. So those aren't overseas side hustles,
Right, they're not just pet projects.
No, those are massive structural seeds planted for a future transition in how capital is deployed.
Oh, I see.
Yeah, they are using the American equity engine to pay the current bills while placing very deliberate bets on the evolution of the financial system over the next decade.
That makes a lot of sense. And that deliberate positioning in the portfolio leads us directly to the velocity of the capital. Because to understand what investors are actively worried about or excited by, you don't look at static holdings.
No, you have to look at the flows.
Exactly. You track the new money. And the overall trend here is an absolute tidal wave.
It really is.
So in the second quarter of 2024, they saw $82 billion in positive inflows. Fast forward to the fourth quarter of 2025, and that number skyrockets to a massive $281 billion.
Though we should definitely note the volatility hidden inside that growth curve, right?
Boy, yeah, it wasn't a straight lineup.
No, early 2025 saw a noticeable retreat. Q1 inflows dropped to $84 billion, and then Q2 compressed even further to $68 billion.
The institutional segment in particular has shown some cyclical stress there, right?
Yeah, having suffered $46 billion in outflows back in Q2 of 2024.
But the script does project a recovery there. They are estimating $44 billion in positive institutional inflows by Q2 of 2026.
Which is a pretty significant turnaround.
It is. Retail long-term flows, meanwhile, peaked at $82 billion in Q4 of 2025 before stabilizing a lot lower, somewhere between 15 and 19 billion recently.
Which is a pretty dramatic cooling off for the retail side.
Yeah, for sure. But the most explosive part of the flow data, and this is what we touched on a minute ago, is the alternative investment category.
Oh, this is the really interesting part.
Right. Client assets in alternatives surged from $474 billion in Q2 of 2025 to $715 billion in Q2 of 2026.
That is just huge growth in a single year.
Exactly. And the fee-paying portion of that grew from $392 billion to $556 billion, heavily driven by private credit and infrastructure.
Which is key, yeah.
So usually when people talk about alternatives, they think of exclusivity. But are institutions flooding into infrastructure because they're terrified of inflation and want hard assets? Or is there a structural shift happening in how they view liquidity?
It's definitely a structural shift.
Because it's kind of like deciding you're done putting your money in a liquid high-yield savings account where you can withdraw at any time. And instead, you become the bank yourself. Like handing out a 10-year commercial mortgage.
Yeah.
You can't touch your money for a decade, but the premium you collect for locking it up is just massive.
You've just perfectly described the illiquidity premium.
Okay, the illiquidity premium.
Yeah. Institutions like pension funds and sovereign wealth funds have known liabilities. They know exactly how much they need to pay out to retirees in 10, 20, or 30 years.
Right, they have a set schedule.
So they don't need daily liquidity for that entire pool of capital. What they desperately need is yield that outpaces inflation.
And infrastructure provides that.
Exactly. And we aren't just talking about toll roads and bridges anymore. We are talking about the massive energy grids and data centers required to power global artificial intelligence deployment.
Oh, wow. AI infrastructure?
Yes. Those assets generate long-term inflation-linked contracts, and private credit operates on a very similar logic.
How so?
Well, as traditional banks pull back from corporate lending due to stricter capital requirements, private asset managers step into the void. And they charge a premium to act as the lender. It is a fundamental shift in risk appetite away from the public markets toward private, predictable cash flows.
Here's where it gets really interesting, though. BlackRock's numbers look genius. They're pulling in billions. Their alternative assets are skyrocketing.
They look incredibly smart.
Right. But are they generating this growth purely through brilliant strategy? Or is a rising macroeconomic tide simply lifting their incredibly massive ship?
The old rising tide question.
Exactly. Because the market didn't just go up, it went on an absolute tear. Between June 30, 2025 and June 30, 2026, the S&P 500 rose from 6,529 to an incredible 7,499.
Which is massive for a major index.
That is a 21% year-over-year increase and a 15% jump just from the previous quarter. The U.S. market was blazing hot.
Well, asset managers charge fees based on the total value of the assets.
Okay.
So if the underlying market appreciates 21%, their fee revenue scales accordingly, even before they attract a single new dollar of client capital. So the 68% America's weighting we discussed earlier, that acted as a massive force multiplier for their revenue during this period.
But look at the global explosions happening simultaneously, too. Emerging markets were up 41%.
Yeah.
The MSCI AC Asia Pacific Index was up 35%. The S&P Global Natural Resources Index jumped 28%. And their own BLK Equity Index went up 32%.
It was a global rally, really.
Meanwhile, the bond market was relatively sleepy but stable. The Barclays Aggregate Bond Index was sitting at 2,363, up about 4%.
Right.
So if emerging markets jumped 41% and Asia-Pacific jumped 35%, blowing the U.S. 21% growth out of the water.
Right. On paper.
Does that mean BlackRock, with only 6% of its assets in Asia-Pacific, is actually missing out on the biggest global growth story?
Well, it seems intuitive to think they are missing out, but you have to factor in the mechanics of currency translation.
Currency translation.
Yeah. During the same period, we saw real volatility in exchange rates. The British pound to the U.S. dollar was at 1.33, and the euro to the dollar was at 1.14. Both of those were down 3% from the previous quarter, indicating a very strong U.S. dollar.
So a strong dollar changes the math.
Dramatically. When you have a strong dollar, it acts as a massive headwind for international investments. Yes, an emerging market equity index might explode by 41% in its local currency due to, say, supply chain reshoring or a commodity boom.
Right, local growth is huge.
But when a US-based asset manager translates those returns back into a strong dollar for reporting purposes, that 41% shrinks significantly.
Oh, I get it.
The heavy U.S. concentration actually provides a stable foundation that doesn't suffer from currency translation decay, while they use their smaller regional footprints to capture absolute growth where they can.
Okay, so the market is hot, the assets are flowing, the macroeconomic tailwinds are blowing, everything makes structural sense.
Until you look at the accounting.
Exactly. Then you get to the actual revenue and expense data on these slides, and the numbers get downright weird. This is exactly why you always have to read the fine print.
It really is.
Listen to these anomalies directly from the source text. The text explicitly states that total revenue in Q2 of 2025 was $4.454 billion, and that it decreased to $1.272 billion in Q2 of 2026.
A huge drop, supposedly.
Right. But in the very next breath, describing another graph, it says Q2 2026 revenue reached $5.726 billion.
Yeah, that doesn't add up.
It is mathematically impossible for Q2 2026 revenue to be $1.272 billion and $5.726 billion at the exact same time.
Very true.
And the expenses are even wilder. The text says total expenses for Q2 2026 were $844 million. But it also states that employee compensation alone increased to $4.168 billion.
Up 28% year over year.
Yeah. How can you pay your employees $4.1 billion if your total expenses are only $844 million?
It's a great question.
To top it all off, general and administration expenses dropped from over $4 billion in Q1 of 2026 to just $6 million in Q2. Are their calculators broken, or is this the financial equivalent of a magician's sleight of hand?
Well, if we connect this to the bigger picture, this is actually a masterclass in the reality of complex corporate reporting and why raw data without context is just incredibly dangerous.
This is not a typo.
No, not at all. What you are seeing is the collision of different reporting metrics, specifically generally accepted accounting principles, GAAP versus non-GAAP or adjusted figures.
Okay, GAAP versus adjusted.
Right. GAAP is the strict standardized rulebook. Under GAAP, if a company executes a massive acquisition, they have to record massive one-time acquisition costs, asset impairments, and specialized compensation payouts all at once.
Oh, so that massive expense spike.
Exactly. That $4 billion general and administration expense in Q1 wasn't them suddenly buying millions of office chairs.
Right.
It was the accounting impact of a massive transaction clearing the books.
So the $4.1 billion in employee compensation likely includes massive one-time non-cash stock payouts for the founders of the companies they acquired.
Precisely.
And then those are stripped out of the adjusted operating expenses to show the true recurring cost of running the business.
You nailed it. The presentation actually notes that operating income in Q1 2025 was adjusted upwards from $1.698 billion GAAP to $2.032 billion adjusted.
Okay.
And then in Q1 2026, net income was actually adjusted down from $2.212 billion GAAP to $2.068 billion adjusted, specifically due to these non-recurring items: compensation, impairments, and acquisition costs.
So when the text gives you two completely different revenue or expense numbers for the same quarter, one is a raw, unadjusted view that includes all the transaction noise.
Right.
And the other is the adjusted view that reveals the fundamental earnings power of the ongoing business operations.
Exactly.
It's kind of like looking at your bank account on the day you close on a house.
Well, that's a great way to put it.
Yeah, because if you just looked at the expenses for that one single day, you'd think you were going bankrupt.
Right, you'd panic.
But it's a one-time structural event. It doesn't reflect your actual monthly grocery and utility budget.
A perfect way to look at it, honestly.
Yeah. So what does this all mean for the people actually holding the stock? We've waded through the accounting paradoxes. We know the flows. We know the scale. Let's get to the ultimate question.
What is the payoff?
What is the actual payoff? Because despite the accounting noise we just discussed, the underlying performance metrics are remarkably strong.
Very strong.
The operating margin dipped slightly from 44.1% to 43.2%, but then it recovered to a highly profitable 45.9%.
That's impressive.
Yeah. Meanwhile, adjusted net income climbed from $1.55 billion in Q2 of 2024 to $2.291 billion in Q2 of 2026. And earnings per share, the EPS, jumped impressively from $10.36 to $13.91.
I mean, that level of margin expansion and EPS growth at a $15 trillion scale, that is phenomenally difficult to achieve.
And it ties directly back into those massive accounting distortions we just talked about. The presentation details their share count and acquisitions, showing that diluted shares peaked at 165.2 in Q3 of 2025.
Right.
And it explicitly attributes this to two major strategic moves:
Great.
the GIP transaction in October 2024 and the HPS transaction in July 2025.
Which were massive alternative platform acquisition.
Exactly. So my theory here is that they diluted their own shares to buy GIP and HPS, using their stock as currency. And now that the deals are done and the platforms are generating fees, we see share repurchases stabilizing around $450 million quarterly.
Buying back the stock.
Right. Plus, dividends, which held perfectly steady at $5 for a long time, are projected to get a big hike to $5.73, starting in Q1 of 2026. So are they basically printing shares to buy the most lucrative alternative platforms and then using the new cash flow to buy back the stock and hike the dividend?
You've completely decoded the strategy.
Wow. Okay.
It is a brilliant execution of capital structure management. We discussed the explosive demand for private credit and infrastructure earlier.
Yeah, the illiquidity premium.
Exactly. Building an alternative platform organically from scratch takes a decade. You have to build the track record to convince pensions to give you billions of dollars.
Right. They won't just hand it over.
Right. BlackRock didn't want to wait a decade. GIP and HPS are premier operators in infrastructure and private credit, respectively. So BlackRock used their highly valued equity to buy the builders of those private islands, acquiring their established track records and immediate fee-generating assets.
So they bought their way to the front of the line.
Yes, and issuing shares to buy them diluted the existing shareholders temporarily, pushing the share count up to 165.2. But once those alternative platforms were fully integrated, BlackRock turned around and used that massive new cash flow to reward shareholders.
Hence the buybacks.
Exactly. They initiate the share repurchases to aggressively bring the share count back down, and they increase the dividend to $5.73 to provide long-term yield.
It really is incredible when you pull back and look at the whole picture. If you just looked at the surface of these documents, you'd see crazy expense swings and confusing revenue drop.
Total chaos.
But when you follow the money and understand the mechanics, you see a master plan. They are leveraging the massive reliable engine of the U.S. equity market to fund strategic acquisitions in the explosive world of private credit and infrastructure.
All while navigating global currency swings to maximize shareholder return?
Exactly. Taking the time to understand these forces isn't just about reading a balance sheet. It is the ultimate shortcut to being a truly well-informed investor.
And I want to leave you with one final thought to mull over.
Oh, please do.
We just spent this time analyzing $15.3 trillion operating under the roof of one single entity. When one company's passive indexes and alternative investments touch literally every corner of the global market, from physical infrastructure to digital assets, it raises an important question.
What's that?
At what point does a single asset manager stop being just an investor in the global economy and start becoming the global economy itself?
Something to think about the next time you look at a map. We'll leave you with that thought.